Hi guys, welcome to this AA revision session. I'm doing this based on your request. And let's go into it quickly. But before I start, let me just remind you that I just posted a revision plan, a 14-day revision plan, which is really good for any paper you are writing. What you must do in your last 14 days to your exams. Please take advantage of it and use it to the maximum benefit. It's free and always available. Share with your friends. And remember, continue to subscribe, continue to share this, your comments. I appreciate a lot, and continue to like the videos. Let's keep the conversation alive. Back to AA revision, where I will always start from is the syllabus. We need to summarize it quickly, and that is looking at an audit engagement. Audit engagement is a project and always going to be a project. It has the beginning and the end, and that is the way you must always see it. And if it is a project, it means that you will always have to plan it. Then you do it, then you report the results. And that is the same way we do audits, right? And we're trying to plan the audit, trying to do the audit, and trying to report the audit. We don't just do it the way we like it. We must do it following the regulations and audit framework, our ISS. So this is our section A of the syllabus. This is section B. This is made of section C and section D. And this is section E of the syllabus. This is the biggest chunk of your syllabus, and I will spend so much time today talking about that. This is very critical as well. And likewise, I will touch on this today. Okay, right. So that is the quick summary of the syllabus. Now we're going to start with planning, which is section B of your syllabus, audit planning. Audit planning. Why do we need to do audit planning? Why is because we want to have an effective and an efficient audit. Because we want to achieve those two things. Effectiveness means that we're able to achieve the result of the audit, and efficiency means that we're not wasting resources trying to achieve our objective. So effectiveness is about the objective, efficiency is about maximizing the inputs while trying to achieve that objective. So that is why we need to plan our audit. And this starts from the stage whereby we are even being recruited as an auditor. Because you ask yourself, why will an auditor accept to do an engagement? So audit is a story, and you have to follow this story because it's very interesting, right? And see it like that. It's not a boring course. It's very interesting. Shareholders will always appoint auditors. Remember, shareholders appoint auditors. And if they have appointed an auditor, must auditor accept that engagement? No. An auditor does not always have to accept an engagement proposal. So even if client have said, PwC, please, we need you to audit us, there are prerequisites to PwC accepting that audit engagement. And that is the starting point where we'll start from. We'll start from the audit prerequisite. And this is categorized into two major groups. The first one is your acceptance testing that auditors must carry out before accepting the engagement. Then when they decide to accept the engagement, if this has passed, then they must sign a contract with the client, and that is called the engagement letter. Okay. Acceptance testing, what is the makeup of acceptance testing? Let's look at that quickly. Acceptance testing. There are three major things that auditors must do under acceptance testing. The first one is they must ensure that the preconditions exist. There are three major preconditions that must be existing before auditors can take any job. The first one is that the client that is asking them to be audited must be using appropriate financial reporting framework. to prepare the financial statements. That's number one. Number two, they must have internal control in place. And number three is that the management must commit to provide all access to information and personnel. Those are three preconditions. It's not negotiable. They must be present. Number two is the professional clearance must be done, which means the new auditor or the incoming auditor must take permission from the client and speak to the former auditor to understand the conditions why did the previous auditor decide to leave the client, just to be sure that there are no issues. It's not like the client is trying to shop for opinions, right? So they must get professional clearance so that the new auditors can know that it is safe and it's a good client they are trying to accept. So professional clearance is very important. The third one, which must also exist, are what is called other considerations. And these are just other factors. And this includes so many things, not exhaustive. So this will include things like the auditors themselves. Do they have enough resources? Do they have staff who will be ready to perform the audit? Likewise, the clients that we want to audit, do they have good credit rating? Yeah, because if they don't have good credit rating, how would they pay our fee? You can't take job from clients that will not be able to pay auditors. You must not owe auditors, right? Also, this client, do they have integrity? You only audit clients with integrity. And also, is there any risk of money laundering? Because auditors must not be part of such audit. A client that doesn't have a legal business, you don't provide service to such clients. So these are other considerations. Remember, these are the acceptance tests that must be done. When this is passed, when you've looked at this, the condition exists, professional clearance is good, and other consideration is also good, then we can now progress and say, now we will accept your offer to be audited and we will audit you. And the next stage is this second stage, which is engagement letter. And engagement letter is just a contract. And when you talk of contract, two people are involved. So it's between the auditor and the client. So both of them will come together and they will agree on terms of the engagement. One thing you must know in this paper is you must know the content of engagement letter. At the minimum, these 5 paragraphs must exist in any engagement letter, and you must know these 5. The first one is there must be a paragraph for the objective or scope of the audit. The responsibilities paragraph is very important, and these paragraphs will specify the responsibility of both the management and the auditors. Okay. Likewise, there will be a paragraph that will discuss the nature of work that will be done. Likewise, the audit will not be done for free. So fees discussion and the basis for the fees, the number of hours, how the charge out rate of the partners, the manager, the seniors, how many of them will be on the job, and all of that will be discussed. And the outcome, which is the report. So the report format as well must be in that letter. So at a minimum, this content must be in the engagement letter and you must know them. Now, once we sign a contract, that is when we have a client. Before signing a contract, there is no client. And remember, before we sign a contract, we must have carried out acceptance testing. Okay, so remember, it's a story. Keep following the story. An interesting one indeed. Now we can now plan the audits because we have a client. And what is audit planning? That is the next thing we want to deal with. Audit planning is just the same way you plan everything you want to do. You want to put everything you need in place such that you are able to achieve what you need to achieve. So it's about resources, execution plans, how I'm going to do it. Remember, you are not doing yet, but you are checking how you're going to execute. What do you need to do? But the question is, why do you need to plan it? You are planning audit because you want to be effective and you want to be efficient. Right? What is effective? You want to achieve the objective of the audit, which is to issue correct opinion that financial statement is true and fair or is not true and fair in all material respect. Right. So correct opinion. Remember, correct opinion doesn't mean good opinion. Correct opinion can also be a bad opinion, which we'll get into reporting. I'm going to give a summary of how to know the type of audit report to issue. Yeah. And efficient is that you use minimum resources required. You don't waste resources. Yeah, the right resources. Right. So that is why you have to plan. Yeah. And how do you achieve these two things? Is by developing two things. The first one is audit strategy. These are the two documents you must have: audit strategy and detailed audit plan. They are two different documents. Audit strategy, anytime you hear audit strategy, think of either STD or sexually transmitted diseases. But if that helps you to know it, please know it like that. S stands for scope. T stands for timing. And D stands for direction. You can also think of NTE. They are similar things. It's still audit strategy, which is about nature, timing, and extent. So this is a broad document. It's broad. It's just a broad plan of how you want to approach the audit. Yeah, you are talking of what areas do you want to cover. Scope. Let's scope cash and bank. Let's scope account receivable. Let's scope revenue. No, you are just identifying the broad areas that you want to cover. Timing. How much time are we going to spend on this audit? We should be able to finish this audit in 3 months. Direction. How do we want to approach the audit? Are we going to be doing a lot of substantive testing, or we're going to be relying on controls? How do we want to approach it? That is what STD is all about. And that is the same way nature, timing, and extent. Timing, you can see timing overlapping. And nature is more about the nature of the work you want to do. It's about the direction, and scope is the how far do we want to go. Extent. We're going to look at all the items on the financial statement. It is impossible because remember, in audit, what we issue is a reasonable assurance. We do not issue absolute assurance. I'm sure by now you know that. It's always a reasonable assurance. Why? Because there are limitations to audit. And it's also examinable. What are those limitations to audit? Because auditors are not always available from January to December, yeah, to know everything that is going on with the company. So it's impossible to go and audit that client 100% within 1 or 2 months. Auditors are not always there, yeah. Management can override control. So auditors cannot also catch all of that. Collusion is there, which can lead to fraud. Auditors cannot pick all of that. So there are always these limitations. Also, timing, you will not always be there. You don't have all the time to do all the audits. So all of this is the reason why auditors are always focusing on the big issues. And when they focus on the big issues, the outcome is reasonable assurance, not absolute place. We cannot absolute. And that is why when we move on, we will talk about materiality, because we only focus on big ticket issues. Okay. Remember, if you have any question, bring it on. as we move on. Because of the time, we'll be moving as fast as we can because we've read. It's not like you are just learning. Right. Now, detailed audit plan. How is it different from audit strategy? Like it says detailed. This is much detailed than this broad view because here you are talking of building an execution plan, which means you'll be asking who is doing cash and bank, who is doing account receivable, when will this person do it, how will it test it, audit procedures. Yeah, what is the person auditing, right? Take for instance, you say, Dio, from Monday to Wednesday, I expect you to audit account receivable and finish it. Then once you finish, by Thursday, you start account payable. By Monday, you start OPEX. By Tuesday, you look at staff cost. And you are telling me I've developed these procedures in your file that you must follow to do. So this is detailed audit plan speaking there, because we're going into details of who is doing what, when it will be done, how it's going to be done, and what is the person going to be doing. Unlike this one that is just a broad document. And that is how audit planning is done. Now, what are the things that take place? Key activities that you must do when you are planning. Key activities. The first one is, I call it ISA 315 requirement. Remember, this standard is arguably the most important standard in audit. And if you don't know any standard, please know the standard, ISA 315. ISA 315 is titled Identify and Assess the Risk of Material Misstatement. How? Through understanding of your client, which is your entity, and its environment. This is your planning standard, extremely important standard. What is the standard asking you to do? It's asking you to identify what? Risk of material misstatement. So you identify it, you assess it, and it told you how you're going to do it. You must do it through understanding of your client. And that is why you cannot do audit without understanding. How do you want to audit what you don't understand? It is impossible. And that is why auditors are required to understand a lot of things about their clients. You're expected to understand the product of your client, their financial performance, their regulatory environment, the industry that they operate, including their competitors and all of that, the internal control system. All of that you need to understand the strategy of the company, mission and vision and all of that. Because by understanding all of this, you will be able to perform this activity, which is to identify risk of material misstatement, which means risk of material misstatement is extremely important for us. Because if there's a material misstatement, then we must be able to issue the right report, which means we will be issuing a modified report and eventually maybe a qualified report. And I will get into the reporting. So you understand the difference between modified and qualified, and you're able to use the right word. Because one thing you need to know in this paper is you must be able to use the right word, right? Okay, so risk is extremely important, and that is why I'm going to quickly talk about audit risk. So that is big during your planning. Audit risk. What is audit risk? Audit risk is just the risk that auditors will issue wrong opinion. That is, if there's a misstatement, auditors will not see it and they will say the financial statement represents true and fair view. Or there's no misstatement and auditors are issuing bad reports saying that the financial statement does not represent true and fair view. Right? So the risk that auditors will issue a wrong opinion is audit risk. And there are three components of audit risk. It doesn't just happen on its own. There are three things that contribute to that. The first one is control risk. The second one is inherent risk. And the third one is the detection risk. Right. Inherent risk is the risk existing in the industry where the client is operating. There's nothing you can do. There's nothing you can do. Nothing anyone can do about this. Nothing can be done. Because once you are a bank, you are exposed to credit risk. You are exposed to government policies on monetary laws or fiscal policies. You are exposed if there is going to be any form of recession or depression, you're going to be affected. There's nothing we can do. Once you're in that industry, you are exposed. So this will always be there. The question is, how big is this for your client? You have to find out. Control risk is the risk that the control that the management has put in place will fail. Yeah, will fail to protect the loss that they're trying to mitigate. Yeah, and detection risk is the risk that auditors will not be able to identify material misstatement. So it's a failure of auditors. Yeah, not being able to identify material. Remember, I'm always using the word material because in audit, we only focus on material items. Remember, because our opinion is reasonable opinion and not absolute. So only material items. Material means significant, important, right? So which means these two types of risks that we're talking about is about the client. This can be managed, this cannot be managed. But this one, detection risk, is in the hands of the auditors. So which means auditors don't have control on the first two, but they have control on detection risk. But auditors still needs to understand what is going on here. And why do they need to understand? They need to understand because there are implications. So we need to know the implications of that assessment. And what is the implication? Please pay attention. This is the implication. What it means is if either of those two, either control risk or inherent risk, if either of them is high, the risk is high, what it means that auditors must make sure that this detection risk is brought down low. And what is the implications? Auditors must do a lot of work so that detection risk is low. That is why they must check control risk and inherent risk and understand it. And how do they check it or understand it? Because through understanding of entity, how do you get the understanding of entity? Just to remind you, if you can't remember, you can do it from inquiries, you can do inquiries, you can do observation or inspection, you can also perform analytical procedures. In fact, these analytical procedures is very important. It's the only procedure that cuts across all stages of audit. You will do analytical procedures in planning, you will do it during substantive execution, and even in closing, you will always do analytical procedure as well to review the final financial statement. Right. So you still can do analytical procedure where you're understanding. Okay. So that's the implication. If control risk is low, which means control is doing fantastic job, inherent risk is medium or low, yeah, then auditors can just do medium work because they don't have to do so much on detection risk because control risk is already low, inherent risk is low, which means the likelihood of having issues from this area is very minimal, then you can really assume that things are working and you expect that that process will be good to the extent that financial statement is very unlikely to be materially misstated. And in that case, you will still do work as an auditor, but you won't have to do a lot of work. You won't have to do this, right? And that's the opposite situation. So that's the implication. Another thing you do in planning is fraud risk assessment. Is mandatory. Engagement partner must discuss with the team the likelihood that the engagement is susceptible to fraud risk. And the major thing you need to know is what I've just said now, and also auditor's responsibility. Please pay attention. What is your responsibility as an auditor? This is a popular question. Please know that you are not expected to detect fraud. Your responsibility is not to go and catch fraud. However, because your procedures are expected to detect all material misstatement, remember, all material, not all misstatement, all material misstatement, then you must be able to pick misstatement that is coming either from error or from fraud. Remember, there's a difference between fraud and error. Fraud is deliberate attempt to mislead, whereas this is accident. But both of them have similar effect on financial statement. They both cause misstatement. So auditors must catch all material misstatement, whether it's coming from fraud or from error. However, please, if you're asked in an exam, your first statement is that it's not the responsibility of the auditors to detect fraud. However, if auditors detect fraud during their work, they are expected to report it, and they are expected to develop procedures that are robust enough to identify and detect material misstatement, either from fraud or from error. Please say that, then you earn all your maximum point. Another thing you do during planning is to set materiality level. Materiality level. And there are two levels. There's overall levels and there's performance level. I hope everybody can see my screen. If you can't see my screen, please speak up. Let me know you can still see it, but I hope you can see it now. Right. So there's overall level and there's performance level. Overall level is looking at the financial statement as a whole. So take, for instance, if you say materiality without setting those two levels, let's say just a materiality is 20 million. What you are saying here is that anything less than 20 million, you will ignore, you will not test. Or any error that is less than 20 million, you will ignore it, it's not a problem. You only focus on error that is more than 20 million or balances that are more than 20 million. So which means if there is $19 million error, you will say, no problem, I leave it. If there is another 18 million, another balance, you will leave it. Then you leave a lot of 15 million. Imagine, eventually, imagine if there are just three items, you have these three errors, 1, 2, 3. If you add all of these together, this is already, I think, 52 million error. Already a lot, which is more than the 20 million. That is why ICA requires you to have overall and performance, such that overall is looking at the addition of all misstatements that you have identified and total misstatements after the audit is done. Because you must always collate all misstatements, whether material or non material, total misstatements, that have not been corrected must be less than your overall materiality. So in that case, you cannot use overall materiality to be testing balances, and that is where the performance materiality comes in. So you must set performance materiality such that when you are testing bank, you are using that low figure, lower, because performance materiality will always be lower than overall materiality. Maybe if overall materiality is now 20 million, then you can say performance materiality, let's say, is 5 million. So everything less than 5 million is ignored, but anything more than 5 million is asked to be corrected and tested, right? So eventually, when you collate all misstatements, you expect it to still be less than 20 million. If it is not less than 20 million, then that financial statement is misstated, right? So each balance sheet will now be tested based on performance materiality that we have given. So if I'm working on bank, I'm checking that there is no error that is more than 5 million. If John is working on account receivable, he's checking to be sure that there is no error that is more than 5 million. So that eventually when we are all done with our work and we sum up all the materiality, all the errors rather that we have detected and that have not been corrected, the addition of everything is still less than the overall materiality level. So the reason for setting performance materiality is to ensure that the total uncorrected error is not above overall materiality level. And how do you set this materiality level? There are rule of thumbs that you can use, and there are 3 of them. You probably remember 0.5 to 1% of revenue can be used. You can use any of these, and I will tell you how this is being tested. 1 to 2% of total assets can be used at the materiality level, and 5 to 10% can be used as your performance materiality. And what I will tell you is, for the sake of your question, just focus on this lower level, because if something is more than this lower level, definitely is already material. So you don't need to be checking this higher range already. Honestly, I don't know the advantage of having the range, because whatever crosses this point has already become material. Right. But maybe you just want to be more efficient in your work because you don't want to do so much work. Because when you did the audit risk, you discover that control risk is very low, inherent risk is very low, so you don't want to do so much work. Then you can maybe then decide to play in the middle. Yeah. However, for the exam sake, this is where they always test it. Anytime you are reading a question and they are giving you profit before tax figure, or they are giving you revenue figure, or they are giving you total asset figure, know that that question will probably require you to calculate materiality because of the audit opinion that you need to issue, right? Because you need to test, and all you need to do is they give you revenue, just calculate 0.5% of that revenue figure. If the percentage is more than, so take for instance, they say we have revenue is $10 million and there's an error of 1 million that has not been corrected. Then what you need to do is, there are 2 ways of doing it. You can say, what's 0.5% of 10 million? No, 0.5% of 10 million is at 5 million. Yeah. Calculate 0.5% of 10 million. And just be sure not to. 5% of 10 million, that's about 500,000. Right. I want to be sure. Actually 50,000. Fantastic. It's actually 50,000. Very small. So which means that is your materiality level. Lower, remember you use the lower range. Right. So that's $50,000. What you are saying is that any error more than 50,000 must be corrected. And if it is not corrected, it will affect the opinion, because it means that the financial statement is misstated. So now you have error of 1 million. What does it mean? It means it's more than 50,000. So this is material. That's one way of doing it. Another way of doing it is you can just do error divided by the balance. Whichever way works for you. An error divided by the balance is 1 million divided by 10 million. What percentage is that? That is 10%. So if the misstatement is 10%, and we know that if you are using revenue, the rule of thumb says anything more than 0.5% is material. And this is greater than 0.5%. So definitely this error is material. So those are two ways you can use to test it. Then in that case, you will now go ahead and discuss that the error must be correct or not. So that is how they can test it. And the last thing that I'll just quickly touch on is on documentation. During planning, you need to have files that you use to document the audit work. You need to get the files ready. And please know that whatever work you do, you must keep it for 5 years. So there's a 5-year retention of audit work. You must keep your work for a minimum of 5 years. Please take note. Right. Now, that is a very quick summary of the planning stage. Yeah. Before we go into, because it's substantive, I'm going to spend a lot of time, right? Because I'm going to use questions to review substantive stage for you, because that's the biggest part of the audit. I want us to spend minimum 1 hour on substantive. Now that we know planning, so we're good with planning, you know how to plan audit now, right? We've planned, we'll come back to execution, which is substantive. Let me quickly touch on reporting. Yeah. Now, reporting, that is the last stage of your audit. This will always be minimum 15 marks in your exams. That's why I want to spend time on it. Yes.
Hi, sorry to bother you there. A quick question. You know the documentation you said you're going to retain for 5 years? I did a quiz yesterday on the study hub, and I put 5 years because in the UK the law is you keep any documents as a company for 5 years.
Yes.
So that's what I went with my gut feeling. But the question come up wrong, saying it's 7 years.
So the minimum documentation requirement is 5 years. So is it on ACCA Hub?
Yeah, it's on the quiz. You know where you practice the chapter quiz? If you send me your email, I'll screenshot it to you and show you where it said that.
Yes, I'm going to see my email address here. I would like to see it. But thanks for bringing that up as well.
Yeah. All right, cool. Thank you.
Yeah. Good.
Okay, perfect.
All right. Yeah. So on reporting, you will always get minimum 15 marks questions on reporting. It will cut across so many areas, and you need to get those easy marks, very easy marks. I don't advise that you joke with it and you miss those marks. A couple of areas it will come up. Yeah. So the first thing I would say you need to always think about is reporting happens at the closing stage of the audit. Remember, you must have done the work. Yeah. And there are a couple of activities that must take place, reviews and all of that. So first of all, you must know the closing stage activities. Yeah. Report is just one of it. Audit report is just one, which I will touch just now. But in addition to audit report, before the audit report is being done, there are other things that must have been done. Going concern assessment must have been reviewed. You must review going concern. You must review subsequent events. Obtain rep letter from your client. I hope you know what rep letter is. Rep letter is just like a liability exclusion for auditors. What they do is they tell the clients to send a letter to them, telling them that, so clients will be telling the auditors that we have prepared financial statements, all the information we are giving to you is complete, is correct, we have not deceived you, everything is complete, everything is being as we have said it, we have put appropriate control in place, and also some balances that are requiring estimate. We have done the estimate based on the best information we have available. So auditors usually ask for this rep letter to protect themselves in case they narrowly miss something out. They say, well, we've obtained rep letter, though it's not the best. You think you will not do a good job as an auditor because you know you're still going to collect rep letter from client, but you still must collect that rep letter. So the representation letter is very, very important. So you get to collect all these things, do all these things during the closing stage. right? Going concern is just trying to be sure that the financial statement you want to sign, that entity has all it takes to continue to exist for at least the next 12 months, right? And for subsequent events, you are checking the events between the date the year finishes and when the report has been signed, and also some activities after the report has been signed. What do you need to do? Are there activities that affect your reporting or no? But where I want to focus more, which is being always tested, which will always be tested, is audit reports. And I want to spend a bit of few minutes on this because students struggle to pick the right report. And I think it's a bonus question for you anytime. You must not miss it. So that's why I'm going to spend a bit of time on it. The first thing you need to know is that there are two types of reports. Either there's a clean report, which is unmodified report. Or there is a modified report, which means it's not clean. So you see where I'm starting from is on modification of report. I am not talking about opinion. Remember that audit report has several paragraphs. Templates. There's a template for audit report in ISA. One of those paragraphs is just your opinion paragraph. So don't always get confused when we're talking of opinion and audit report. Opinion is just a paragraph. It's just one paragraph. Other paragraphs you'll find in audit report. So when we're talking of modified reports, it means that this template has been modified. We are not necessarily just talking about the opinion. Other areas could have been modified. Maybe we have added a new paragraph. It's been modified. And that is what this part is talking about. But when we finish that audit and we completed the audit report template and everything is clean, the financial statement is fine, is free and fair in all material standard, then that report is unmodified because we have just used the template nicely as it is. Now, when it is modified, there are now two types. Either you have qualified opinion, which means now we are talking about this paragraph. That means this paragraph is affected. Then it's a qualified opinion. If that paragraph is not affected, then it's unqualified. So when it's not qualified, it means that we did not touch this paragraph. The opinion is still fine. However, we must have added new paragraphs. And there are two types of paragraph that we can add. Either we are adding emphasis of matter paragraph or other matter paragraph. Now, how do you know when it should be unqualified? Because, in fact, let me start from the top. How do you know whether it should be modified or not? Once you ask yourself, once there is no error in the financial statement, there is no uncertainty, there is no issue, everything is perfect, it is unmodified. However, once there is an issue, whether there's a disagreement, whether we are just unsure of the future of the company, or whether they are doing something that we don't like, once we have an issue, then it's going to be a modified report. The question is now, is it going to be a qualified opinion or unqualified opinion? If the financial statement is free of error, then you can go this way. But if it is not free of error, then you come this direction. So sometimes financial statement is correct. However, you just want the users, the shareholders, to put their focus on a particular item. We want to raise their awareness. Mostly, we do this side to get awareness of users because there's something we want to bring to them. We want them to see it. That is why we are adding a new paragraph. And we are letting them know that we have added a new paragraph. And that is either an emphasis of matter or other matter. If it relates to the current financial statement, you use emphasis of matter most times. However, maybe if it's just about the future plan or something, then you can be using other matter, but they are closely related. Mostly what you will get tested on is emphasis of matter. They hardly will give you something on other matter because it can actually be confusing, whether it should be EOM or other matter, right? Now, if there is an error, which means financial statement is not correct, then it has to be a qualified opinion, which means we need to issue a bad report. This is where clients don't like it. In fact, modified report, they don't even like it. But when it now gets to qualified opinion, they are scared of it. And this one can be 3 types. The way I'm going to do it for you, I'll do it in a way that you will not forget, and I'll use a table for it. Yeah, because there are 3 types, and what determines the type that you issue is whether the issue that you are talking about, the problem, the error you are talking about, is it material or pervasive, or what is even causing this issue that we are talking about? Do we have disagreements? Or there's a limitation of scope, which means they did not give me information. Limited access to information. That's another way to think about it. So there's limited access to information. Those are the 2 considerations that you need to think about to know the type of audit report. So let's take this column as row as materiality check. Is it material or is it pervasive? Now, what is causing it? Do we have disagreement on standard treatment? IS2 has said inventory should be measured at lower of cost net realizable value. And he has said you should never use LIFO. Your client is saying we are using LIFO and we believe it's acceptable. It's a modified version of FIFO. They just try to tell you things, but you disagree vehemently that this is not correct. I don't believe in this. There is a disagreement. Or is there a limitation of access? Limitation of access means you don't have enough information. They didn't allow you to inspect the inventory, so you couldn't do inventory count. That's the limitation of access, right? Pervasive means that it's not just material, but it's affecting almost the whole financial statement. The profit and loss account can be concluded to be wrong because the profit is wrong. And that is also affecting statement of financial position, affecting cash flows, then that is a pervasive issue. So when you ask yourself, is this issue material? If it is yes, but is it pervasive? No. Then you ask yourself, is it disagreement or limitation of access? Whichever way, once it's a material issue and you have concluded that it's not a pervasive, which means it is not affecting the whole of financial statement. It is just a part of financial statement. Let's say maybe it's just provision. Maybe it's just accrual is understated. Or maybe you're just saying inventory balance is understated or is overstated. Or PPE is over. So you're just looking at one item. Then it's always going to be an except for. Once it's all just about single item that is material, is except for. If the item is not material, which means you have done this test that I taught you here, this place that we did. Imagine if this error was 40K and they are asking you that the client has refused to correct this 40K. What type of audit report should you issue? You calculate your materiality. Your materiality is 50,000. This error is 40,000. It's less than materiality. You ignore it. In that case, you issue a modified report because it is immaterial. So you cannot waste time on it. It doesn't affect our decision as auditors. It's not significant. We don't bother ourselves about it. But if it's more than 50,000 for that question, which means it's material, then the next question is it pervasive? You need to check this pervasiveness. If it is not pervasive, then you stay with except for. However, if you discover that it's pervasive, maybe it's revenue figure. Revenue figure is a big item in the financial statement because it's going to affect profit, it's going to affect account receivable, it's going to affect cash flow, it's going to affect a lot of things. So most things that affect revenue will be pervasive. And if it is now a disagreement, which means we're just fighting how to interpret IFRS 15 and all of that, then in that case, it will be an adverse opinion, which means you will be saying clearly that this financial statement does not represent true and fair view of the financial affairs of the company in all material respects. Remember, except for is different because in except for, you will say the financial statement represents true and fair view in all material respect, except for inventory, except for property, plant, and equipment, right? So this is still better, but adverse opinion is worse. And the worst of them all is when it is pervasive and you still have limitation of access, then in that case, you issue a disclaimer. And here, this is no reports, no opinion. Auditor is saying that they cannot express opinion because no work has been done. They couldn't do their job. So they cannot express any opinion. We've done good justice to that planning stage. And I'm 100% sure that you've held the most important part of that stage of audit. Now, the second stage is execution. The reporting you'll find now as well. Please, if you need to take the picture of that table that I did, I hope you did, but I will publish this video as much as possible. I can maybe later in the evening on the channel. So if you want to rewatch, you can still rewatch it. Right. So section C and D is on internal control and some substantive testing. And they are the biggest part of this syllabus. The only thing is you can't understand them without understanding the planning, right? So internal control, I won't spend too much time on it. I will spend more time here. Two reasons. Number one is because this is more complicated. And number two, I have short recordings already made on internal controls on my playlist, the AA. If you go to AA playlist, you will see that I've done good job on internal control. Currently, I just finished revenue process on that. So that can help you. You can listen to it while on bus or while you're commuting or something, or probably planning to sleep. That will do very good justice to internal control. But that doesn't mean I'm not going to touch on it here. Internal control. What is internal control? Internal controls are just policies, procedures, guidelines that management are put in place to ensure that they achieve their objective. Yeah, the objective is to make profit. The objective is to secure the asset. The objective is to pay on time. So they have different types of objectives. But if they don't put controls in place, those objectives might not be achieved. So to ensure that those objectives are achieved, they put controls in place because there's always risk. So they mitigate those risks. Now, why is it important for auditors? It's important for auditors to understand controls because it impacts on our planning. Remember, when we were planning nature, timing, and extent. One thing that will influence the extent of work that we need to do is the outcome of control testing. If the control testing, we tested the controls and controls are bad, if controls we conclude they are bad, then extent of work must be huge. We'll do a lot of work because we need to compensate for that bad control. Because if control is not working, it's almost saying that the whole of financial statement will be in mess, right? But if after testing control is good, then the extent can be a bit medium because we don't have to do too much work. So control testing is important for auditors so that they can determine the extent of work that needs to be done. So it influences our planning, right? And ladies and gentlemen, auditors don't test all controls. you don't have to test all controls. Remember, your responsibility as an auditor regarding control is number one, you must understand. After understanding, you document, then you evaluate. When you evaluate and you decide that this is a good control, that is when you will test. You don't always have to do this fourth stage until your evaluation of the control is good. And what are you doing here? Remember, for every control, there are two parts of it. There's a design and there's operation. If you say, because we need to secure our cash, let's do reconciliation monthly. That is a good control. So the design of this control is fantastic. However, if Dio that is meant to do the reconciliation just feels like they're just wasting my time with this reconciliation control, I will do it every quarter. Then the operation is bad. In that case, your evaluation will fail. So once the evaluation has failed, you don't need to test. You only test when the evaluation is good. Then you now want to test to be sure that, okay, let me really see that this thing is working the way it should be working, because the design is good and the operations now I can check. Right. So when you are testing control, you are testing for design effectiveness and operation effectiveness to see whether the guy is operating the way he should be operating it, even when the design is good. But if they say the design, instead of doing monthly operations, they say we'll do reconciliation once in a year, then that design is poor. There's no need wasting your time to test it, because this will not catch anything. It's not going to work, right? So that's just background of controls, and different processes have different types of controls you will expect. But please, what you always think about is when they give you a question on control, always answer in tabular form. Is usually will not go beyond things like asking you for weaknesses, which is risk, consequence, what could go wrong, what will be missing, then maybe control objective, which is what the control is trying to achieve, then the control activity itself. Yeah, control activity, which is like reconciliation and all. Then they can now say design the test procedure and how you do all of that. Like I said, there's a video online that does a good justice to that already. So let's spend time on what I've not touched before, such that you can get the best from this time. Right. Okay, so let's go to substantive testing. Make this slightly bigger. Yeah. Substantive testing. This will be minimum of like 30 marks. So we can't joke with this. Very important. And a lot of students struggle with it. And where I'm going to start from is, please understand that when you get to substantive testing, what you are trying to do is to gather evidence. At this point, you've already done planning, you've done control assessment. It's now time to gather evidence so that you can document and conclude audit. So this is evidence gathering stage. And we don't gather evidence for just to mark time. We gather evidence because we are looking for comfort as auditors. And that comfort is to ensure that our audit risk is low. Remember the component of audit risk. We want to bring that component down to low. So we are looking for comfort. How do we know that we have the comfort? We will know we have the comfort when we have addressed appropriate assertions. So what I tell students is the reason why you will struggle to develop audit procedures is when you struggle with assertions. So ladies and gentlemen, anytime you are faced with substantive testing, start from what are the assertions that are relevant. So that is why I will tell you quickly a bit about assertion. Assertions are your what I would call your audit objectives. Those are the things you are trying to achieve. That's the comfort you are trying to get before you can say a particular balance is correct. And it's different from P&L, though similar, and statement of financial position. So when you are dealing with P&L item, take for instance revenue, you cannot be comparing the assertions with when you are dealing with account receivable. But there are some that overlap. So for P&L, you have occurrence, you have cutoff, completeness, accuracy, P&D is there, classification, order. When you are looking at statement of financial position, yeah, it's similar to occurrence, but you don't call it occurrence because it's account receivable. Instead, you call it existence. So that is why in some literature, you probably see occurrence / existence. You use occurrence for transaction, you use existence for balances. So revenue has occurred, but account receivable exists. We don't have cutoff for balance sheet items, but you will still have completeness. There is accuracy, but sometimes you can call it valuation. It's the same thing, but you're allowed to use accuracy as well. Yeah, but mostly you use valuation, especially when you're talking of things that have to do with estimate and also account receivable. Yeah, P&D still very relevant, and classification. Now, just a bit of understanding of what these assertions are. Occurrence, what we are saying is, when you are auditing revenue balance, the first thing you must ask yourself is, did that transaction occur? And how do you know that the transaction occurred? Then you'll be asking for either a contract of sale or invoice. Because when you know assertion, you must always think of assertion. When you think of assertion first, you would not struggle to develop audit procedures. Students struggle to come up with a lot of audit procedures because they are quick to jump into procedures when they are thinking of balances. Think of assertions first that are relevant for that balance. Is it P&L item or SFP item? When you know, then you know your assertions. Therefore, each assertion, you will develop audit procedure easily. Because if you are auditing revenue, the question you're asking yourself, how will I have comfort that there is a transaction that generated that revenue? That is occurrence. Then, how do I know it occurred? Then there must have been a sale agreement or there must have been an invoice. Then ask for invoice for selected samples of revenue items. Now you develop a procedure for occurrence. What is cutoff? Cutoff is saying you must ensure that transactions that occur before the year end are recorded in the year of financial statement, and the transactions that occurred after the year end are not included in our financial statement for this year because they don't relate to this year. That's cutoff. So you are building a wall and you are cutting the year off. That is what it means. This before the year end, we record. After the year end, we don't record. So that is cutoff testing. And how do you check that? What you'll be doing is also to be checking dispatch notes. The dispatch note is the only item that shows when we sell, when the items left us. And if it is items that we only record sales when the client has received it, then you'll be checking that yes, the dispatch note has also been signed receipt by the client that they have collected the goods. Then you are asking for dispatch note before the year end to be sure that those sales have been included, and the dispatch note after the year end have not been included. Completeness, you are saying that every transaction that occurred in the year of audit has been recorded in the year of audit. Complete. That all we are looking at is complete. Everything is here. Remember, it's very close to cutoff, but it's not the same. Cutoff is looking at both years, before and after the year. Completeness is focusing on the year alone and ensuring that everything is inside. Accuracy is that the amount is correct. The amount is correct. It's supposed to be 20 is 20, not that you recorded 21 when it's meant to be 20. So you have to be adding things together or be checking the amount on the invoice. You need to find a place where you can find the correct amount. Is that you find the correct amount on the invoice, on the sales agreement, or you find it in a confirmation letter, or you find it in a circularization, or you find it, you start, that will get you thinking depending on the balance again, because I can't teach you all the balances you need to know. There are about almost 7 balances you need to be able to develop procedures on. Yeah, but I want to give you a template that will work for any balance they give you. At least you'll be able to develop procedures. Even if you cannot develop as much as they need, you will develop enough to get you past, right? So think from the assertions, right? P&D is presentation and disclosure. What you are saying is, if it is revenue, it has been presented in profit and loss account. If it is account receivable, it has been presented in statement of financial position and in current asset part. Presentation and disclosure. Classification is about putting items where they should be classified properly. If it is depreciation, this depreciation, is it production related depreciation or admin related depreciation? If it is production related, then it should be part of cost of sale. If it is admin, then it should be after gross profit, which means it can be admin expenses or any other expenses. Right. So you are looking at where they are classifying things. Yeah. And existence is that, does that balance exist as at year end? Do we truly have a receivable from a customer? You ask yourself, how do I confirm that there's a receivable from a customer? Then I should send a confirmation letter to the customer. That's it. Then I write the letter to the customer, confirm to me that you are owing this person. Once the person confirms to me, then that means my client is not lying. Truly, the balance exists. Completeness. Yeah, I'm going to tell you some of the procedures you can use to test completeness, depending on the balances as well, is to ensure that everything has been included. And valuation is, we are saying that the value you have called this asset is it true that is that value? If you say account receivable is 40, how am I sure that you'll be able to get this 40 back? That is valuation. If you say PPE is 40, remember, asset is resource controlled by an entity through which you expect economic benefit to flow in. So is that economic benefit equals to the amount that they have put on the financial statement? That is the valuation. Would they recover that amount? Valuation is about recoverability of the value. Either you are getting it from value in use or sale. Those are the only 2 ways you can get an asset, right? So are we going to convert that value of asset into real value for the company? That is what you are checking there. And P&D is just as I've explained earlier. So please, it's always from assertions. That's how you always address your substantive testing. Right. Now let's quickly see how much questions we can do. Right. And I'm going to start with this question, which is let's look at 52. Yes, this question. Audit evidence and internal audit. Yeah, we just focus on the key ones. Yeah. No, let me look for prefer. Yeah, let's do this one. Let's do Andromeda. It's fully substantive. I don't want mix. That's so much time. Right. So look at Andromeda. I believe you can still see my screen now. Yeah. So let's deal with this. The question A says 4 factors which influence reliability of audit evidence. Quickly, reliability of audit evidence. Remember, they might also ask you in this way. It's a revision class, so I might answer more than what the question is asking. Another way they can ask this question is to say, what are the 2 factors you consider for audit evidence? Naturally, when you are talking of audit evidence, there are 2 things you are looking at. You are looking at reliability, and you are looking at sufficiency. What this question is testing is reliability. Yeah, but sufficiency is also very important, because you must get reliable audit evidence, and likewise you need to get sufficient audit evidence. They are both important. So it's not just one, but both of them. Yeah. And when you're talking of reliability, the factors that the question is asking for now is for you to know that third-party evidence is the best. The source is what determines the reliability. That's one, source. Is it from third party? Third party is the best evidence. Likewise, is it in forms of nature? And you're checking whether it's written or verbal. Please, in audit, we don't like verbal evidence. So this is 1, 2. So written evidence is better than verbal, please. Take note. Yeah. And also, you need to know that original documents are always better than photocopy. Right. And auditors' evidence. If auditors can get the evidence themselves, it's better than what you get from the client. Right. So that is reliability in terms of how strong you can rely on that evidence you have gathered. Yeah, if I'm writing to a third party, say a customer, confirm this balance to me. Customer is a third party. It doesn't have any interest, any personal interest in the auditor, the client that I'm auditing. So I will rely on that rather than client telling me that this is account receivable balance and I should just take it hook, line, and sinker. No, third party is always better. Likewise, nature written, definitely I've explained that. Then original, you can understand why that is important. Original document are always better. And auditor's evidence, definitely, you're going to trust yourself, right? And sufficiency, they might also ask you, it's not in this question, but they might ask you that what will influence the sufficiency of audit evidence. Remember, sufficiency is about amount of evidence, amount. So it's about the risk. If the risk is high, amount sufficiency will be, you need a lot of evidence. So risk is directly proportional to the amount, right? Your materiality as well, important, is a factor. Remember, materiality shows the minimum item that must be tested. So the lower the materiality, the more work you have to do. And let me also tell you quickly, there's a relationship between risk. So if risk is high, then you must set your materiality to be low. Why? So that you do a lot of work. Yeah, please learn how to link them together. If audit risk is very high, then you have to set materiality to be low so that a lot of balances will qualify as significant and means a lot of work, and vice versa. Right. Yeah, control is also important. If control is good, remember, control is part of the audit risk. So if control is good, then you won't have to do so much work. But if the control is bad, you will need to get so much audit evidence. So before the audit evidence can be sufficient, you have to do a lot of work. So those are just a few things I want to add to that question. So that's A part of the question. Let's go to substantive, which is B. Right. Quickly, let's read this. I believe you probably have read it while I was talking, but let's go through it quickly. In audit exams, always read your question before you read the story. Always, so that you know what you are looking for. Now, question B. Describe audit procedures you would perform during the audit of Andromeda Industry Co. 1. Before and during the inventory count, and 2. In relation to the R&D expenditure. Look, before you go to the question, look at the marks. 8 marks, 4 marks. The same way you score, you must know how many items they want you to write. So if it's 8 marks, be rest assured that it's going to be 4 points on each column. Yeah, please always try and use column to answer your questions in AA, because most times there will be marks for presentation, right? Sometimes you even write it there that there's a mark for presentation. So please, especially when you have more than 2 things, right? So before and during. Yeah. So before inventory count, we'll need to find out. So this is, we need to add 4 points each, because to be rest assured I will end at 8 marks. That is the minimum we do. Right. Now let's read. This guy, Andromeda, develops and manufactures a wide range of fast-moving consumer goods. The company's year-end is 31st of December 2020 and forecast profit before tax 8.3. This is what I'm talking about. Anytime you see a question that's giving you profit before tax, you will need materiality testing somewhere. Please take note. That is why, and I can already see it here in this question. That is where we need. There is audit report testing here. See? Discuss the issue or describe the impact on the audit report. You can already see. So we are coming there. And it's 4 marks. We'll come there. Okay. So you see that. So you are the audit manager of Neptune & Co. and the year end is due. Audit is due to commence. Yeah. The following information has been gathered during the planning process. So inventory. Andromeda's raw materials and finished goods inventory are stored in 12 warehouses across the country. Each of these warehouses is expected to contain material levels of inventory at the year end. It is expected that there will be no significant work in progress. There will be no significant work in progress. Yeah, see, if there's a work in progress which can be tested, yeah, I'm giving you all the points. It's a revision class. So whatever comes to my head, I will tell you. One procedure you must carry out on work in progress is to get expert opinion. This one has now told you there's no work in progress. The same question can come under PPE, can come under inventory, can come anything that has work in progress. Don't test it as auditor. You as auditor, you test it by asking for expert. So in your procedure, you write it there that obtain expert reports on valuation of this item, because work in progress is one of the things that are so difficult to value, to measure. So you cannot just do it by yourself as auditor. But this one say they don't even have. Each count will be supervised by a member of their internal audit staff, and the count will all take place on this date when all movement of goods in and out of the warehouse will cease. Is good. Now, let's deal with that before we go to R&D. Now, what will you do before and after? Before and after of inventory count. This inventory count is extremely important. Inventory is very likely to come out in exam. Inventory, revenue, things like that, yeah. So that's why I'm happy with this question, inventory, right? So what do you need to do before inventory count is almost all about planning. And the first thing is you need to obtain client instruction, their procedure. You need to get that. You get it, you review it so that you know what you're expected to do. Then you need to select locations that you want to visit. Because you have 12, right? Are you going to go to all the 12? Or you need to select some locations based on some reasons? You need to consider that. Locations. Resources. You need to ask yourself, who are the people that will be going? How many of them will be going? Is it one for each location? Depending on the amount they have, do I have 2 in this location, 3 in another location, right? And likewise, you need to plan logistics. How will people get to those locations? All these things is about before planning. During, what are things you need to do? The first thing is the reason why you are there. You need to observe the count. So you need to observe because that's the major thing you are doing there. Yeah. Then when you observe, after they've done their counting, you now need to test. And you do your test in 2 ways. I call it floor to sheet and sheet to floor. Right? So floor to sheet means that you are going from the warehouse shelf, the warehouse storage, and you are selecting a particular inventory area and you are checking it against the report. So the report is the sheet. So what I'm saying here is you're going to sample a location, yeah, and confirm on count sheet, yeah. Then you do the opposite again. Select on count sheet as well and recount on the floor. Sorry. So what I'm saying here is, take for instance, you have a count sheet. The guy said on this particular shelf, there are 113 bicycles there. That's what you saw on the sheet. Then you pick that particular rack and you say, I want to count myself, then you go to the rack, then you count the bicycle 1, 2, 3, up to 113. If it is true, what you have done is you have done from the sheet to the floor, right? Or you can walk across the warehouse and just randomly pick a particular rack that is floor to sheet. Then you say, I'm counting this rack. What is the number of this rack? This is rack number 10. Okay, how many bicycles are here? 5. 1, 2, 3, 4, 5. Give me your sheet. Let me see. Go to rack number 5 and let me see how many you have there. Oh, you have the same number. Fantastic. So you've gone both ways and you find. And the last thing is you collect a copy of count. You collect a copy of the count. Very important. That's the evidence. You have to even sign to show that you were there. Another thing you need to do is during counting, you need to ensure no movements of inventory. So I'll just give you 5, right? So those are before and during inventory count. And remember, if you're auditing inventory, perform inventory count is always one of your procedures that you must perform, right? Because that will address your existence for sure. To also address your valuation, because you could have seen inventories that are damaged or that are missing. Right. Now let's look at the two parts, which is R&D. In relation to the R&D expenditure, what are the procedures we should do? 4 marks, which means we must have minimum of 4 procedures. These guys. Always look at the marks, because that's why students will say, I answered, but I did not pass. Because he was able to give 1 or 2 procedures, he thought he has killed the exams, whereas the exam is still alive. The exam did not die. Okay, so let's look at the R&D. This guy spent over 2 million annually on developing new product lines. This year, it incurred expenditure on 5 projects, all of which are different stages of development. Once they meet the recognition criteria under IS 38, they include the cost incurred within intangible asset. Once production commences, amortization commences as well on a straight line for 5 years. Now, we're asked to develop procedures to audit this part. Remember, I said assertions are very important. So when you look at R&D, R&D is the balance sheet items, right? So which means we're talking of existence, right, and obligation, right? Include right and obligation in my assertions. I forgot that here. There's rights and obligation, please, guys. It's part of the assertions for balance sheet. Right is for assets and obligation is for liability. So rights will be there, competence will be there, P&D will be there, and classification will be there. So we'll be looking at all those assertions. So this is what we want to test. And also, when you look at an item, also remind yourself, what is the IFRS requirement for that item, right? So for this particular item, R&D, you know that there are criteria by IS 38, about 6 of them. So which means you must also be testing with those criteria, because those criteria will actually confirm whether there's an existence. Yeah, there's no O there. It's only right because it's an asset. So I'm going to move this. Okay. What are those 6 criteria? But before you can capitalize R&D, remember R&D, generally research costs are meant to be expense, but some research expenses can be categorized as a developmental cost. And in that case, if it qualifies, then you capitalize it as an asset. The risk is that clients will always want to overstate assets. And they can also ask you in exam, what is the audit risk on some balances? Please know that when you are talking of assets, it's always about overstatement. Assets and income, that is your audit risk. Any asset and income item. And if it is about liability, it's always about understatement. The audit risk is all about understatement of liability and expenses, because we want to increase balance sheet and increase profit, right? So the risk is that research expenses that should have been expensed and profit would have been low will not be posted like that, but rather they will be capitalized so that asset is now overstated, then expense is also understated. And to prevent that, you need to check to be sure that they are truly assets. And how do you confirm that they are truly assets? That the asset truly exists, they have rights to the economic benefit, they are presented it correctly. You need to test against those 6 criteria of R&D. R&D is a popular question, so it's good that we pick it. So please take notes, and you'll be checking ability to use. Yeah, technical feasibility. Remember, very important. Intention to complete the project, right? Do they have resources to complete? Because you might have intention, but you don't have the resources. I'm sorry, you can't do it. Yeah. Would there be a future economic benefit on that asset, right? Is there a way of measuring the cost reliably? These are the 6 criteria that we want to test now to address these assertions. So now, though the question only going to give us 4 marks, so any 4 will be fine, right? However, it's good you have the 6, so that if you have it in exam, which is possible, then you're lucky. It's fresh. Go kill it. How do you test for ability to use? What will be your procedure for ability to use? All you need to do is to check in what is the likelihood that that item actually will be able to sell in the market if they want to sell it, and if they want to use it. Is there any report that you can leverage on? Is there any experience of other companies you can leverage on to be able to conclude that yes, they will be able to use that item? And how do you write your procedure? Please, your procedure must always be an action word. It must be compare, obtain, assess, inspect. You must start with action word. So what you want to do is you say, okay, obtain, take for instance, a research report. And what are you looking for? You just want evidence that this item has some values. This item is usable. This item is good, is important, is useful, right? So you obtain a research report that shows that the product has been used before by any company, or if it's a patent, very brand new product that has never been used, before they go into that work of producing, they should have done some research reports themselves that will show that somebody will need it, yeah, or usable. If it has never been used before, there should be a research report that gave them that confidence. So you need to get that, right? Technical feasibility. What is technical feasibility? Technical feasibility is just saying that, do we have enough technology? Do we have enough resources, technically, the knowledge to really complete this project, right? And how do you confirm that? They must have done a prototype, like a sample, a test result must have been done, right? So what you do is you obtain that sample product, because that is usually done first. Sample product is what you call a prototype. A prototype, yeah? And check if the product's requirements are met, because the product will have its requirement, things that it should be doing. So collect that prototype and see whether it is doing what they have said the product will deliver. Because what they should be doing now before they start capitalizing, because prototype is the outcome of your research before you start the commercial quantity production. So can they do it? If the prototype is working fine, then they can do it. So technical feasibility is not a problem. It's fine. But do they have intention to complete? How do you know whether they have intention to complete? Minutes of meeting. They will be discussing the progress, the next thing, and all of that. So to get them to give you assurance that they have intention to complete, you just need to inspect board minutes of meetings. Yeah, where they have discussed that they are supervising the project, and the active conversation is going on to give you confidence that they will complete it, right? So what is the next one? Resources. They have adequate resources. That is budget straight away. So obtain budget for the project. Yeah. And why? You need to check that there is sufficient fund, yeah, to complete. So once they have sufficient fund in the project, in the budget, then it means that they will definitely be able to complete that that project. But if they don't have enough budget, then there will be a problem for sure. Yeah, so you need to. That's how you're going to check that. What is the next thing to check? Future economic benefit and cost measurement. For future economic benefit, it's similar to what we have said before. This first one, yeah, if the product has been used before, or there's a research that shows that there are people who will need the product, so usability, that will address that as well. And in terms of cost measurement, you just need to check how they have been accumulating the cost. So I would say obtain the cost accumulation schedule. Yeah, obtain the cost accumulation schedule, right? And validate samples with invoices. Right. So you will see that we have addressed this question based on those 6 criteria, but it's not all balances the WAF criteria like this. Yeah. But once you are addressing those criteria, what you are addressing is existence, right? Existence go with right, because if it exists, most likely you will have rights to the economic benefit. So you can see when we're talking of economic benefit here, yeah, we're already addressing rights assertion here. We're addressing existence assertions here. Obtain sample product, yeah. Does the asset exist? That is what we are addressing here as well. Most of all of these criteria will address that. However, here we're talking of cost accumulations schedule, right? You can check the additions, which can be another process, another procedure rather. Like you want to cast. Cast means add, yeah. The cost schedule. Give you another procedure. Yeah. What are you checking? Check the accuracy of the schedule. We want to be sure that they've not made mistake, and that is addressing accuracy assertion, right? So if you look at this, we've addressed existence, right? Completeness because of that. Even casting will address that completeness as well. Likewise, we have P&D left, and you can add another one. Even presentation and disclosure. Addressing all those criteria will also address your P&D. But most importantly, you can also write that inspect financial statement and confirm that this P&D balance, yes, has been recognized as non-current asset. It's also a procedure, and you're fine. Very fine. And amortization is part of it, because the question also touched on amortization. So you need to, anytime you hear amortization, depreciation, any estimate, please, there's a general procedure you must always do. That is check for reasonableness. Reasonableness. Maybe they are talking about allowance for depreciation, allowance for allowance for account receivable, anything that is estimate. Please always know that there is a standard procedure. Check for reasonableness of assumptions and policy. Don't just say check for reasonableness, because you only get half mark to do that. You must always compare with something. That's how you check for reasonableness, by comparing. So you must have a benchmark with industry standard. Easy, just compare with industry standard or a peer company. Yeah, can compare with a peer company. Right, so very important. Then you can recalculate amortization figure. Because if amortization figure is wrong, then your R&D balance will be wrong. Remember, your R&D balance is opening balance, which is cost, less amortization. And that's how you have the closing balance. Is this closing balance that you are auditing? So you are checking the schedule. You need to check the amortization before you can say the closing balance is correct. So those are all sort of procedures you could have done on R&D, and you will be fine. Now let's look at C. Yeah, I rented this location for 2 hours, guys. So if I got extended, I'll be able to stay longer with you to solve more questions, but hope not. If someone has booked and I have to leave, then we'll reschedule. Hopefully I'm able to find another time. If not, maybe we'll just be chatting, and we'll keep supporting you virtually online until your exams are. Okay, so just to mention that to you. Now, C, it says that during the audit, the team discovers that one of the 5 developmental projects, this is the value, and included within intangible asset, does not meet the criteria for capitalization. So they have a disagreement already. Does not meet this capitalization policy. The finance director does not intend to change the accounting treatment. So the FD is difficult and stubborn and says he will not change it. Now you have been asked to discuss the issue and describe the impact on the report if any of the issue remains resolved. So the first thing is test for materiality. Before auditors will expend any energy on any balance, materiality testing. Is it material? How do you know it's material? The only benchmark that has been given, remember, we can use PBT for materiality to check our materiality. We can use revenue, and we can use total asset. But this question has given us PBT. And I told you in the template that I gave you that if it is PBT you are given, the lower end is 5%. So which means our materiality will be 5% of PBT, and that will be equals to 5% multiplied by PBT they gave us is 8.3. So 8.3 million, and we check that 5% of 8.3 million. That's 415,000. Yeah, so that's our materiality level. So which means anything above or equals to 415, okay, is material. Is material means that is significant. Please. Writing very fast, so pardon me, please. Just know I want you to get it right. And I want to cover as many things as possible. Okay, so if 415 is material, the problem we're having here is 980. So is 980 material? Definitely. 100%. So 980 is material. So this is a problem. So which means we need to correct it. So that's a discussion. So discussing is not just about the audit report. Your discussion, first of all, is auditor needs to test for materiality to check if the item is material. Now, we test for materiality, 980,000 is more than 415,000. Therefore, this amount is material. Because the amount is material, client must correct the error. They must correct the error, which means they must classify this 980K as expenses and not assets, right? However, as the question says, if the issue remains unresolved, the impact on audit report, then you go to your table, check your table. This table, you don't need to draw it in exam. It's just for you, please. Yeah, let's even use the one we've drawn before. Or we can just quickly draw another one. Yeah, just for a revision. Remember, you have materiality, you have pervasiveness, you have disagreement, and limitation of scope, yeah, or access. If it is material, is except for, it is pervasive, it is adverse, and this is disclaimer, right? So this is disagreement that we're having, and it is material. It's not pervasive. It is just R&D. Yeah, it's not going to affect our profit, P&L, or the whole of balance sheet. It's just a balance that is not correct. So it's except for opinion, we're going to issue. So your conclusion is that a modified report and a qualified opinion called except for will be issued because the item is material and is as a result of disagreement of accounting standard. Full formats, and you're done with this question. Now look at Metcalf. Audit evidence requires that auditors should obtain sufficient appropriate audit evidence to be able to draw reasonable conclusion on which they are required. Like I always say, read your requirement first, then you can go to question because that will guide you to focus on the real issues and not necessarily scrambling to answer. The first requirement says list and explain the factors which will influence the auditor's judgment concerning the sufficient. Fantastic. Remember, I told you about this. I said sufficiency and reliability you must know. Reliability is about the source, about the nature, and all of that. Third party is the best. Auditors is better than the client. Original is better than photocopy. Written is better than the verbal. That is about reliability. Now it's about sufficiency. And I also told you about the sufficiency that control is important, will influence how much audit evidence you need. Materiality will influence, risk will influence, and also even the reliability of your evidence will influence. Because if your evidence is very reliable, you don't need to gather so much. But if they are not reliable, then you might need to gather so much to convince yourself that you've addressed the risk. Okay? So it's very interesting. So I'm not going to go into that much. B, what is the requirement? List the substantive audit procedures that you should undertake in the audit of current liability of Metcalf for the year ended this. And for each procedure, you must explain the purpose. So you can see, you must do a tabular representation in this question because it has two components. The first component is the procedure, and the second component is the purpose. In fact, when I teach this substantive test, I always tell my students, don't just always write the procedure. These guys are just lenient to have split it this way. Even if they have asked you to write procedure, your procedure will not be complete until you state why you are doing it. And do you know why you are doing it? Is the assertion. That is what they're asking you now. Assertion. Take, for instance, if you say, let me quickly, before I answer this question, let me just quickly give you some expo. Like when I say expo, some easy shortcut to some procedure. There are some general procedures that whatever they give you, it will be relevant. Casting schedule of that balance to check for accuracy. There is no balance that you cannot cast. Casting means you are adding together, and that will address accuracy. Right? If it's a balance sheet item, you can check opening to prior year audited financial statement. Please note that this is only for balance sheet items. It's a procedure that will address completeness for you, right? And this is an you can also do analytics. You can say perform analytical procedures by comparing current year and prior year and ask management explanation for major difference. So I'm giving you these 3 procedures, especially for guys that are really struggling to cover the syllabus, or maybe you are thinking you're never going to pass these exams. Please, these are the things that can just push you across 50, right? Maybe you are struggling a lot, because these 3 procedures will always pass. Yeah. I just wanted to mention that and keep it there for you. Okay, back to business. Now, we've read the requirements, procedures, and purpose. Like I told you, purpose are the assertions. So now, the first one is the trade payables, and they've given us this financial statement. This is a trade payable that I want audit. Yeah, these are accruals, and this is provision for legal action, right? So we're auditing all of them. The first one is trade payables. Look at trade payables, 9 marks, which means you are advised to have 9 procedures. Where do I start from? You already have a place to start from. So that's what we're going to address quickly now. And remember, the assertions is where you always start from. So you want to address a lot of assertions. Trade payables, this trade payable is not a P&L item, it's a balance sheet item. So because balance sheet item, we'll be talking of valuation or accuracy, as both of them are allowed. We talk of existency, we talk of obligation. Please, this is not current, this is obligation. Yeah, sometimes I call it R&O so that I don't mix it up. Yeah, we talk of completeness and P&D. Yeah, presentation and disclosure, very important. So when you want to form this procedure, these are the assumptions we are talking about. So first of all, when you have to write so many procedures, start with the easier ones that I've given you. Yeah, if there are not many, then you can focus on specific assertions. But let's quickly, first of all, write the easy ones, which is first of all schedule. So number 1 is about casting the schedule. Naturally, if this question has not said that we should separate the procedure from the purpose, I would have just said the first procedure will be cast the schedule to confirm the accuracy of the balance. That would have been your proper procedure. However, because this question has tried to make life easy for you, so you can say cast the schedule. That is enough as a procedure for this question, because you have another column that completes that procedure. And what you have to do, the purpose is to ensure accuracy of the account payable listing total. So casting means that they've given you different list of account receivable. You said is going, Mr. A is B, Mr. D is this amount, Mr. C is this amount, and they've added everything up together to a particular amount. But you need to be sure that the additions that they have done is correct. Because if it is not correct, the balance on the financial statement will be wrong. Remember, it's the addition on that schedule that they have transferred onto the statement of financial position. So you have to cast to be sure that it's correct. So that is one procedure you've already addressed, and that is, you can put in bracket, accuracy. Number 2, go back to that, check opening paragraph, because it's a balance sheet item. You write it there, check the opening balance of account payable and agree with prior year FS. Because remember, account payable usually start from opening
balance. Then you have purchases, so plus purchases minus payment. That's what will give you closing that you are auditing. So this is the balance you are auditing. So which means to audit this balance, you need to audit this guy, you need to audit this guy, you need to audit this guy, right? So when you are forming your procedure, you can see all other areas that you can consider where your procedures can come from. Because likewise, the payments also you need to audit. And how do you know that we actually made a payment? We will be tracing to bank statement. But we'll come to that. Let's keep going one after the other. So you check the opening balance. And why are you doing this? Because you want to check for completeness. Completeness of AP balance. Yeah. Now you can now start doing analytics. So you test for A and C. You're still moving. Right. So you can do analytics. And for AP, there are different ways you can do analytics. You can compare, so you say perform analytics by comparing the current year with prior year and obtain explanation for significant differences, right? This will address, this one you address, so to ensure, remember everything is to ensure. I'll stop writing it to ensure, so I'll just write this summary so you can pick it from there. This will give you completeness and likewise will address existence for you. Because by the time you compare current year with prior year, something's, if there are huge difference, you'll be asking yourself, why is there a difference? Then you need to go to the client. Is the client that will now explain to you, oh, it's because we made these payments, because we bought these things, and they will be able to explain to you why you have that difference. Then that doesn't mean that the audit has ended. You can still do another analytics. Yeah, another procedure you can do, right? Which is to still perform analytics. I'm still on analytics, another form of analytics. By calculating actually account payable days for current year and prior year. What are you trying to do here? What you are trying to do here is you expect the account payable days to be comparable. So if there's huge difference, then something must be missing, because remember, account payable days formula is equals to account payable balance divided by cost of sales or purchases, that way, times 365. So if this days is reducing, it means that this balance is reducing. So if you do AP days for current year, 2024 versus 2023. In 2023, it was 45, and in 2024 is 15. That means that account payable in 2024 is low. Then that means we need additional evidence to actually show why that balance has gone so low. Why is it so low like that? You need to get evidence why it is so low. And that is what analytics is helping with in there. So this also will give you completeness, existence, and accuracy. Anytime you do analytics, S is your assertions. They will always be addressed. Accuracy, completeness, and existence. Yeah. Okay. And we're still going because we have so many procedures that we have to write. We've written 4. Now let's go back to our assertions, because looking at it, we don't have more procedures, right? We still have a lot to write. Right. Think about existence. We've not even looked at existence. We've touched on accuracy during casting. During analytics, we touch on accuracy. Now, existence. What can we do? Remember, existence is about that balance. Does it exist? And what will make the balance to exist? We must have bought something. We must have bought something. That is why there will be account payable, because account payable means we are owing somebody. So what will make us to be owing somebody? It means that we must have bought something. So what kind of evidence can auditor collect to confirm that we are owing somebody? It is either invoice or good receipt note. Remember, let me give you a quick revision on purchase cycle. On the purchase cycle that creates account payable, remember, and it starts from you place an order, yeah, PO, issue PO, yeah, then the order is delivered, delivery. When you receive it, they issue a good receipt note. Because on delivery, you have a liability. This is where obligation starts upon receipt of the item. And at this point, you must book entry. Please take notes. It's on delivery that you must recognize liability. But because there is no invoice at this stage, they've not given you invoice, they've only delivered to you. And the only thing you issue is good receipt note to show that I have received this item. You must do an accrual. So here, the entries you will post is to debit expenses, if it's an expense, or inventory, if it's an inventory. And you credit accrual. In practice, this account is called good receipt account. In practice, if the accountant here, you probably have heard of these entries. When invoice comes, when you now receive invoice, which means you need to process payment, the accrual reverses. That's why you keep reversing accrual every month and rebooking it until invoice comes. So the day invoice comes is the day you will not rebook accrual again. You just debit accrual. Because instead of reversing the accrual, you now debit the accrual and you book AP, account payable. You now book into the vendor's account. Is this vendor account that you're going to process for payment? Right. So that is the way it works. So once there's a delivery, there must be good receipt note and accrual must have been recognized. So which means the best way to confirm that we have a liability, that this liability exists, is to select sample of AP items and trace to respective good receipt notes. What is the one trying to address? It's trying to confirm existence. It's to confirm existence of the balance. That is trying to confirm the existence of the balance. And I hope it's making sense to you. Because by the time you try to validate the existence, the only way you can validate it is by checking the source document. So, and I'm going somewhere because source document gives you existence. When you go from GL to source document, what you are trying to get is to confirm existence. But you can also go in another way, which is when we start talking about completeness. But I'm coming back to that because I still want to address this completeness even more. Yeah, so GRN, that's a source document. Another way is you can also use invoice. Remember, invoice can also come, they also invoice because now you need 9 procedures. So every sensible procedure will get a mark. You don't necessarily say because you've addressed accuracy, then you don't need to add more procedure on accuracy. Please, every sensible procedure that comes to your head that makes sense, you need to include it. Don't stop yourself. You need to keep including it. So, which means you can also do the same thing, but instead of tracing to GRN, so please repeat I don't want to write it full because of time. So, however, trace to this time around. So repeat number 5, but trace to invoice. That will also address existence of the balance. You see that you are building procedures a lot now. It's getting plenty. Now, number 7. So we've been able to address existence in our assertions and accuracy. Yeah, and when we address existence, we're also addressing the rights because that gives us rights. So for existence and rights, right? Anything that addresses existence addresses the rights. That's another clue that you need to know. Right, fantastic. Now let's look at completeness. Let's try and address completeness in our assertion. How do we address completeness? Ladies and gentlemen, please note this, and I will tell you because students struggle a lot with completeness. Every time you trace from the source document to general ledger, you are testing for completeness. So remember, existence is general ledger source. This is existence. But when you go from source to GL, it's completeness. Because what you are trying to do is you are trying to revalidate, just like what I explained to you when I was doing inventory counts, that you go from sheet to floor. Sheet to floor is existence. But when you go from floor to sheet, which means I'm now going to the original item, to the source, and I'm going to from there to the GL record, then I'm doing completeness. So if I pick a fixed asset now on the floor, I saw a chair, I said, this chair, show me where you have it on your financial statement. I'm doing completeness. But when I go to financial statement, I say, what is the balance of financial statement? PPE. A chair is 50 million. Show me this chair. Then I'm testing for existence of that chair. So please understand that same procedure, just tweaking it the opposite, you can actually address 2 assertions. Yeah, so note those clues because it's important even in your account receivable as well, not just for purchases. Yeah, if you go from AR balance to invoice, what you are doing is existence. But when you go from invoice to AR balance, that is completeness, and you have 2 procedures already. So, ladies and gentlemen, let's test for completeness of AR. And what we'll be doing is we're going to go from GRN, so sample of GRN because and trace to the general ledger. What you are testing for is completeness. You are testing for completeness of that of the account payable. Simple. That is what you are doing. Yeah. So the same way, you can also select samples of invoices before year end. Yeah, and trace to GL. Still completeness. You will get your score. You will get your marks. Because remember, we've only tweaked these 2 opposites, and we have 4 procedures already. And you can see why they actually come up with those procedures. Yeah. Right. So still on completeness. Another way you can test completeness is what we call test of unrecorded liabilities. Any liability, another way to test for completeness is to select samples of payments just after the year end. And I'll tell you why. Just after year end. And check that the liability was recorded. Yeah, in the financial statement. Remember, if you are paying a liability just after the year end, there is a likelihood that you must have been owing that money before the year end. That is what you are trying to do here. So that is why you're going to select those payments that they made before just after the year, January 2nd, January 3rd, and you are asking, what does this payment relate to? we're owing somebody. When did you owe the person? Last year. Okay, now I have to check to be sure that you have included it in your account payable for that year. You are still checking for completeness. Please take notes. Okay, so that's quite good. 9 procedures there. You can, let me give you just some extra so that it's not just because, like I said, it's a revision class. I don't know which one will stick to you. You can also review the account payable listing and check for unusual items, e.g., debit balances, because account payable must be credit balance. So seeing debit balance there is unusual. So, and that will affect the completeness as well. And likewise, accuracy of that balance. So those debit balance should not be in account payable. We don't want it. It shouldn't be there. And which assertion do we have left? Not touch P&D. So you also, number 11, check that AP balance has been classified as current liability in statement of financial position. That is P&D status. You have 11 procedures, ladies and gentlemen, and that's trade payables. Now let's go to our accruals. Very easy. Now accruals. Remember, these cheap procedures will always pass and will always help you. Casting, comparing with opening, all of that, you will score 100% in those procedures because they are correct, right? So casting, just like we did before, helps you with accuracy. Please don't just write casting like this in exams. Write it the way we always write it. Cast, accurate, schedule, and agree to total to check for accuracy of the listing. So that's what that is trying to achieve. Yeah. Likewise, the same assertions is what we are looking at. Remember, accuracy, evaluation, existence, rights and obligation. This time around, obligation, completeness, and looking for presentation and disclosure. So let me quickly correct this. Yeah, please. For this GRN, it's okay to put it here because we want to have more, but please don't always talk about invoice when you are talking about accrual. Because remember these entries that I give you. Accrual happens when you have GRN. But when you have AP, you must have collected invoice, right? But the reason why you will still be okay to talk about GRN in AP is because you cannot have AP without GRN. And you cannot have AP without invoice. So both of them you can still use to test, right? But when you are testing accrual, please don't talk about invoice because once there is an invoice, there cannot be an accrual. Accrual must have been reversed. So if you are using accrual to test, sorry, if you are using invoices to test accrual, that's a wrong testing. You only use invoice to test account payable because once invoice is presented, accrual should be 0 because accrual must have been nullified. So what you are checking here for existence of accrual is to select sample and only trace to GRN because that's what creates the accrual. Yeah, and here you are checking for existence. Yeah, very important. You can do analytics like I gave you, simple analytics. You can do prior year, current year comparison and investigate difference with the clients, right? That will give you your CAP, your ACE, sorry. Your ACE, accuracy, completeness, and existence, right? And likewise, you can do recalculation of accrual because they are always the basis for getting that accrual figure. You can recalculate it to pass as well. Yeah. So please take notes. What about completeness of Akura? You can also go, remember, opposite of this, give you completeness, which is now from source. Sample GRN, which is the source of the Akura, to Akura ledger. Agree to Akura ledger. So you sample some GRN and you agree the figures to Akura ledger. That is completeness. 5 procedures. You only need 3. The last one is legal action. Are we still there? Just to check. I know you must be tired now. This is the last one.
Yes.
Yeah. We're here.
Okay, fantastic. So now legal action. Talk about the procedure and likewise the purpose. Yeah, so the procedure and purpose. What's the legal action? Okay, they told us a bit about the legal action. Yeah, so the provision for legal action relates to claim from a customer who suffered an injury while assembling a chair. This is very common. Legal action, very common question. They always like to test it. So please pay attention to this one as well. Legal action is an estimate. So anytime there is estimate, I've told you this slightly before. When you have anything that is estimate, yeah, think about expert opinion. When you are developing procedure, think about reasonable, because that is how you test for reasonableness. Yeah, think of reasonable testing. Yeah, yeah. Representation letter, please get a representation letter from clients as part of the procedure. You will get marked for it. Collect representation letter. Very, very important. Collect that. So those are standard procedures that you can do anytime you have an estimate. You can also do a recalculation if you have enough basis to do that, right? So those are generic procedures that can be used. Yeah. So now let's go into this one, legal action. Legal action is a liability. So the same assertions are valid. Existence, right, and obligation, completeness, P and D. Yeah, we need 4 procedures to be able to do this. Right. Accuracy. Let's do with accuracy. How do we know that 60,000 is correct? We need to write a letter to the lawyer. We need to send confirmation letter. Write confirmation letter to client's lawyer. Please, that's after client consent. Yeah, to provide estimates of the case. Because you as an auditor, you cannot tell the value. So you need to write that letter, and that is to confirm the accuracy of the figure. Yeah. Once that is done, let's test for existence. How do you test for existence? That there is truly a legal case. You need to obtain the client submission. Remember, he said there's a client that got an injury, so we must have notified them. So you need to obtain that letter. Another way to check for existence is that you obtain the invoice that the client also used to purchase the chair, because he said while installing the chair, that's when he got injured. So they obtain the invoice to also check for existence of the case. So because these 2 things confirm the existence of that case. This confirms the value of exposure that we have, right? But likewise, how do we know that we'll lose this case and we need to make a provision? We need to get expert opinion. So also obtain lawyer's opinion on the possible outcome. Because If the outcome is remote, and lawyer says they are sure that the client will never win, then we shouldn't have it on our financial statement. So that means we don't have any obligation. So this one will address obligation. And you have your 4 procedures and 4 marks intact.